Hey family, welcome back to another episode of Journey to Harmony. I'm your host, Richard Harmon, and today I wanted to bring you a brief explanation, elementary explanation of the banking crisis that we're currently facing. So let's go ahead and get right into it. Over time, and in the past, we have a system, what is called fractional reserve banking. What we do is, as consumers, as cash depositors, we take our income and we deposit it into the banks, and we expect that those banks will hold our money for us, allow us to be able to use that cash digitally, to be able to transfer, to receive direct deposits, as well as to charge things with as well. What the bank actually does is they take our money and they hold maybe 10 or 20% in reserves, and then they take the remaining amount and they lend it out. So that's commercial lending, that is business lending, that is credit cards, automobile lending. All of these things are ways of how they make their money. So they take a portion of that money and they say maybe 0.1% to 0.5% normally, and they'll give you back a return on that income. And for the longest time, we haven't really noticed. It hasn't really been a thing. Inflation wasn't too high, so people didn't really care. But banks were bringing in, as you know, with credit cards, up to 29%, sometimes on these investments, and they were making a killing for the most part on this money. And we see all the time about how big bonuses are paid to executives at banks as a result of this. So what has happened is, beginning in 2020, the government began giving out cash after they kind of shut the country down, forced everyone to remain home. So they gave out a whole bunch of dollars and a whole bunch of stimulus checks, your stimmy check, to the regular people, to you and I. And we received these checks, and we took this money and we put it in our reserves with the banking system. So as a result, we had some of the highest savings rates in U.S. history during that time period. People were putting money away because there was nowhere to go and nowhere to spend this money. So banks became flush with cash. There was so much money, I believe it's in total, it was somewhere around $13 trillion was put into circulation from the bank and from the overall loans and different packages that were sent out during that time period. So banks now are sitting down and they have all of this cash that are flush with cash. So they do what is, and generally in that environment, what was pretty wise at that time, they take that money, some of the excess cash, and they decide to put that into additional investments that will pay them over time. So they take that and they put it away in the U.S. treasuries and in the bonds and different things like that. So they're expecting, a 3 to 5% return on their money. And that money's locked away, unfortunately, for 3, 5, 7 years. And during that particular environment with low interest rates, it didn't seem as much of an issue. The Feds had kept the interest rate since the Great Recession at near 0%. So if you're getting 3% back while your interest rate is 0%, that's a pretty good return overall. But we all know that as a result, the inflation began to take off because of all the money in circulation. We know that the cost of things, people were paying close to $1,000 plus in terms of their car loans. And additionally, with work from home, a lot of commercial buildings were empty for the most part for years at a time. And because it's commercial building, you have other buildings, you have your restaurants, you have your hotel stays, and all these different things were mostly empty during the time of COVID. So these loans and the businesses, additionally, businesses were flush with cash because people were spending money. There was so much money in circulation, people didn't really have to worry about it. Now, all of a sudden, as last year in March of 2022, the Federal Reserve has started raising interest rates at the fastest pace that we have seen in U.S. history. And what that does is that makes the cost of money significantly more expensive. So businesses are used to borrowing money for operating expenses. So they'll borrow cash, they'll get a low interest rate, and they'll be able to operate their budgets as a result. And they weren't really touching their reserves too often. Now, all of a sudden, they have to use that cash, and they're burning through cash at a faster rate because people are not buying. They're worried about what exactly is going to happen. Are they going to lose their job? There's a pullback overall in the system at that point. So banks, banks are now faced with an issue. They were faced with an issue during that time period. And this is where we see things like Silicon Valley Bank and Signature Bank and Credit Suisse as well. What was happening during that time period is that these commercial banks, they were basically bleeding cash, and their interest rate resets every 3 to 5 years. Some maybe longer than that, maybe 7 years or something, but their interest rate was resetting. So instead of them, continuing to pay, this is currently the commercial real estate crisis that is happening right now. They basically are just giving these investments back to the bank. So the banks are losing money from these investments. So you have people who got car loans that were almost $1,000 per month during COVID, and those people are no longer able to make those payments. So you have car loans crashing, you have commercial lending crashing, you have people defaulting on different things as well. And at the same time, you have businesses that you have lent money out to, and they're burning through cash. So you're having a exodus of your cash from both sides. And then what happens is investors find out about these situations, and they go out and they tell their other constituents, hey, get your money out of this bank. And this is essentially what happened to Silicon Valley Bank, that people ran out and they went for their money. But in general, the money was locked away. So as a result, the banks tried their best to sell the treasuries and the bonds and the different investments that they took that extra cash and put it in. They tried to sell it, but the Federal Reserve was giving a better return return on their cash than what they were offering. So it's like, someone tells you, hey, I can give you a 3% return, and someone else tells you I can give you a 7% return. If both things are equal, you're going to go to the person with a 7% return. So that 3% is looking less and less appealing to most people. So now this situation is something that is multiplied throughout banking. We saw something happen in Europe with Credit Suisse. We are hearing about Deutsche Bank and some other places as well here in America. And the issue right now is that as long as inflation remains high, the interest rates that the Federal Reserve has, the overnight lending that they do, the Fed funds rate, it's going to have to remain high. And if that remains high, then the overall investment that these banks have made over time continues to be, not want to say useless, but it's continued to be not as appealing as what you can get from whether it's your money market or it's your buying treasuries or US bonds or something like that. So as a result, when we're looking out over and seeing what exactly we can expect, it only makes sense that that this is going to continue. What people are finding out is that there's about 5 or 6 banks that the government won't allow to fail. I'll name a few here. You got Wells Fargo, you have Bank of America, you have JP Morgan Chase, and a few others as well. So what people are doing, people who are leaving their money at everyday banks, the government covers up to $250,000, but above that number, you kind of leave your fate in your own hands. So if you're someone who has $2 million, if you're someone who has $100 million in some instances, it doesn't really make sense anymore for you to leave that money there after you've seen the crash, the collapse of a bank. So these small banks right now are hemorrhaging cash, both from the commercial side in terms of the real estate. They're losing money from car foreclosures and car repossessions. You have some other defaults in terms of credit cards, and on top of that, you have people who are taking their money out of the banks. So almost overnight, you go from having almost $1 billion in cash to almost down to a fraction of what is it that you normally have, and banks are closing. So with this, the question now asked is, what can we expect for the future? Will this continue, or is this something that that is over right now and everything has stabilized? But just in terms of that overall diagram that we spoke about earlier, is that this seems, as long as the Fed funds rate remains high, it means that unfortunately that people will continue moving their money out of bank accounts. And if banks continue to lose money from these commercial lendings and different things like that, they will be forced to to end up closing if this is something that continues. So how exactly we get out of this, it will be determined on, unfortunately, the Federal Reserve. They will have to lower the interest rates at some point. The bond market is kind of playing and expecting them to have that cut by July or sometime in the summer, and we'll see exactly what happens. Many people are thinking that the Federal will hold their money for longer, but we'll see exactly what happens and see whether it's the Fed is right or whether the market's right. What are your thoughts on this? I am not an expert by any means, but to give you a basic explanation exactly what's going on, please comment below, like, share, and subscribe, and come back for more Journey to Harmony. Thank you.